Welcome. My name is Cassandra Kirby. I am a part owner and lead advisor at Braun-Bostich and Associates. I'm also a certified financial planner and an enrolled agent. So today in this segment, I wanted to talk to you a little bit about things that you should be thinking of as we near the end of the tax year and things that you might want to have a discussion with your CPA or your tax preparer on before things close out on December 31st. So there's several planning opportunities that you should consider taking advantage of throughout the year and also at this time before the close of the year. And also, if you had like a change in situation, for example, maybe you moved to a new state, you retired, you got married, you inherited some assets, took a new job. So these are all things that, in addition to just having an end of year conversation, would prompt you to really make sure that you did that so that you didn't miss out on opportunities or have a heads up on what you might see at tax filing time. So, first off, it's a good idea to kind of compare your income this year to the prior year. So, if you're making more income, you had bigger bonuses, you did different things than the year before, you want to be sure to take a look at your state and federal tax withholdings to make sure you're withholding enough tax, and also quarterly estimated tax payments. Should you be making quarterly estimated payments? Now we're so far into the year, so there's one more estimate to be made, but you should still have a look at that and start planning ahead for 2025 as well. One thing to really be mindful of is the safe harbor rule. And what that is, it's the amount that you have to pay in to federal and state tax to avoid underpayment penalties. So at least if you owe tax, that's fine, but you really don't want to have to pay a penalty on underpayment because you didn't meet the safe harbor rules. So that's something we can help you more with, and you can also talk to your tax advisor more about that as well. Second thing, you need to be really mindful of what did you do within your investment portfolio throughout the year? Did you have significant capital gains? That's something that you want to take a look at also throughout the year. At the end of the year, it's especially important because you may be able to offset some of those gains with losses inside of the portfolio. Now, the last couple years, markets have performed really well, so there may not be as many losses, but maybe you have an older asset that's you've been holding on to and you have losses there. You can sell some of that and offset some of the gains, which will help to reduce your tax liability. So that's really important. Something to keep in mind and something to talk to your advisors about before the end of the year because you still have a little bit of a window. Um, Inheritance. So if you inherited money this year or even recently, like maybe at the end of 23 or sometime in 2023, you should also discuss these with your tax preparer. So typically, when you inherit an asset, it's tax free. Not always, but typically. But then what you do with it from there, the income it earns, when you sell it, those are the kind of things that can generate taxable income for you. So you need to be really mindful of the asset that you inherited. You want to make sure that your financial institution has properly updated your cost basis so that when you sell it, you get properly taxed on the gain. And this depends on how you inherited it, who you inherited it from, when. So what I'm talking to right now is just very general. So be mindful of that. If it was an IRA, you should also be mindful of withdrawal requirements and the taxation on those required withdrawals. So these are additional things that you can talk to your financial advisor about, and specifically your CPA or your tax preparer. The next one that you should think about doesn't always apply, but did you buy, sell, or refinance a home this year? That's important because you want to make sure most people qualify for a tax-free sale there's certain requirements and exclusion amounts, but most people qualify for that. But you should be mindful of that going into the tax filing season. Also, if it was a vacation property or something like that, those types of sales are taxed differently. So you want to be really mindful of sales on homes that are not considered your primary residence. Um, if you had been deducting points on your tax return and you paid your mortgage off this year, then you might be able to deduct the remaining points in the current tax year. Another topic that has become of importance and really a nice tool for offsetting your tax liability is, are you making charitable donations to different institutions, 501c3s that you support? And how are you doing that? So there's several ways that you can reduce your own tax liability while also meeting your charitable intentions. One is called the Qualified Charitable Distribution, referred to as QCD. With that, you can take money out of your IRA. So if you're of the age where you're forced to take money out of your pre-tax IRA and pay tax on it, you can send some part of that or all of it, depending on the amount, directly to a 501c3 organization, and then you don't pay tax on that amount. Some other things to consider alongside the QCD is a donor advised fund, which is a separate account. You put money into the donor advised fund, and in that year that you make the contribution, you get a tax deduction. You have to itemize deductions or use a Schedule A to be able to do that, but that's another nice tool. And what you can do with the donor advised fund is you could front load, like, or they call it bunching, maybe 2 or 3 years of charitable giving so that you get a higher deduction in that one tax year. So there's still plenty of time if you're interested in doing that, that you could do that for 2024 before the end of the year. Um, just a couple other little things, like, are you newly retired? That's something to think of. And this kind of goes back to your tax withholdings. So if you're newly retired, um, did you start a pension? Have you started Social Security? Those are things you want to think about, because you may be able to, rather than making quarterly tax payments, you could withhold appropriate amounts from the pension or Social Security. It's also important at retirement and even before to take a look at your tax bracket, so where you're going to fall throughout the year, and maybe you can do Roth conversions to fill up your tax bracket. So what I mean by that is, let's say that you're in the 12% tax bracket and you've got room for another $10,000 to $20,000 before you get kicked up to the next bracket. Well, you could do Roth conversions and take advantage of that gap. Um, this all depends on your personal situation. So some of the other factors in your life, factors in that particular tax year, but these are things that you want to be thinking about, especially now, if there's a little bit of room that you could take advantage of doing that before December 31st. Also, if you need additional income, so if you're retired and you need additional income, there's some different things that you might want to look at there, like tapping into a home equity line of credit, maybe using a universal life insurance policies for some extra income, and that would be usually tax-free. So those are a couple things to think about. If you have a child that is in college, you want to be mindful of the American Opportunity Tax Credit. So you can get up to $2,500 a tax break for each child within their first 4 years of school. So again, having these conversations with your tax preparer or your financial planner helps to trigger them to understand your situation and where they might be able to make some suggestions for you. Alongside the education, if you're contributing to a 529 plan, you are likely eligible for a state tax income deduction. That's dollar for dollar deduction on your state income in Pennsylvania. And it's up to the annual gifting exclusion amounts. So this year, you can gift $18,000 to as many individuals as you want. And that's the cutoff. So if, let's say, you have two grandchildren and you gave 20,000 to each of their 529s, then you would be able to offset $36,000, 18,000 each on your state from your state income for that 529 contribution. So that's a nice benefit. It reduces your taxable income, but you're also giving to 529s for your kids or grandkids. If you got married this year, you got divorced, if you were widowed this year, again, those are all situations where you should be talking to somebody about adjusting withholdings, taking a look at what you're going to owe or get back at tax time. You want to be, you want to have a heads up on those kind of things so you're not caught off guard with a big tax liability. And on the flip side, um, you know, getting a refund is nice, but that's money that you could have been using throughout the year to do other things with, or even have it earn some interest. So you want to also be mindful of what could be a potentially large tax refund at tax time. A couple things, lastly, take a look at your savings for the year. So now, you can only put so much into your retirement plans, like your 401k, your 403b. It's a little bit late in the year now. If you didn't put as much in as you wanted to, those contributions have to come out of your pay. So you could still adjust it maybe for the last couple of pays, but you want to think about that for next year too. Is at the open of the calendar year, should you be adjusting your 401k, 403b savings, and should you take a look at pre-tax or Roth or after tax? So just an overall look at how you're saving. And for Roth contributions and regular IRA contributions, you can make those for the prior tax year up until the tax filing deadline. So for 24, you can make a Roth IRA contribution until I believe it's April 15th of 2025. So you do have a window for regular and Roth IRA contributions, where with the retirement plans, you don't. You're kind of shut out at the close of the year. The other thing is take a look at the cash that you have laying around and what it's earning. Interest rates are still, pretty high, even though the Fed has brought rates down a couple times since September. But if you have a ton of cash in a checking account or a savings or money market that isn't really earning much, now would be a good time to put that money to work. We have some options for that. Take a look at CDs, just ways to make your cash work a little bit harder for you if you don't intend to use it or invest it otherwise in the short term future. So, okay, those are just a couple things to think about as we're mid-November here and we're entering the last month of 2024. And one thing that's really important when you're making smart financial decisions is to keep the professionals in your life, like your financial planner and your tax preparer, your CPA, informed about what's going on. That's how you can get really good advice. If you let them know, then they understand what your situation is and they can plug in different ideas and different suggestions that fit your situation for that year. So make sure that you communicate with those people and use them. That's what they're there for. And that's what we're here for. So if you have any questions on anything we talked about today, just call the office or shoot me an email. We'll be more than happy to go back over and touch on anything that's specific to you. Thank you. Thanks for listening.